everyone. Welcome back to Ask Avidian. This is Jake Borbidge, Chief Investment Officer with Avidian Wealth Solutions. And joining me again today, Robert Palmer, our Head of Financial Planning. This is an impromptu exit because there was just something so topical and I think so pervasive in the market that we just had to bring it up and do a quick podcast about it. So this will be the last podcast of 2026, but might be the spiciest one that we've done so far this year. I'm really excited about it. Robert, you are a fan of the show LANDMAN, are you not?
I absolutely am.
Okay, and the episode, which I also watched over this last weekend, I think it came out on Sunday, really, I think it really hit home for us in the finance and the family office and the wealth management world. Would you agree with that statement?
I would agree. I heard acronyms like PIC being thrown around and insurance and shell games with corporations.
It was checking all the boxes, right? Hitting all the hot buttons. I think, and you know what it told me is this is probably how people that actually work in the oil patch feel during every other episode, right? They are going fast forward through a bunch of different things, throwing out terms. Some of them sound really credible, probably used partially in the correct way, partially incorrectly. I think in reality, somebody doesn't die every single day on the job in the, in that industry, but like we're pulling all that exciting, stuff into a show. And so this week's show definitely hit home on the financial planning side of things, big time. So there was a discussion between, I don't know if we're going to name actresses and actors, but there was a discussion between the wife and the attorney, right? Talked about insurance. So tell me what they said about insurance, what was accurate and what was maybe a little bit oversimplified that we can educate our audience on.
Yeah, just for context, here's essentially what happened. There was an oil rig that was insured, and the oil rig got destroyed in a storm, I believe. And so insurance paid out to cover the cost of the replacement of that oil field.
$400 million, right?
400 some odd million dollars in a giant lump sum, which for the record, that never gets paid out like that. Normally, insurance carriers will...
They don't just write $400 million checks?
God, no, that's not how that works. Usually it goes to a bank of their choice and they release funds as project or progress reports come in to pay overhead and pay those invoices. Yep. But in this case, Monty, I believe his name was,
there you go,
convinced the insurance company to just fork over the full $400 million. Now, normally this would go into the rebuilding process, hence the insurance coverage. But instead, these funds were funneled into a different corporate entity, which then purchased a bunch of private or alternative investments rather than going to build out this new rig.
So why did they put it into this other entity?
Oh, great question. I would say it's probably because they were trying to hide where the funds were going. So basically, instead of it going directly to a general contractor, or perhaps it could be going to a contractor, but instead it went to this separate entity that the bank probably didn't, or the insurance company, I should say, didn't know about. And because they didn't know about it, they weren't tracking where the money was going, and therefore they could just put the money anywhere until it eventually would catch up to them, in which case they'd have to report it and say, hey, where the heck is the money?
So what were they talking about where they said, just go buy another thing and then insure it again and then buy something else you want and insure it again? What was that all about? It seemed like there was a tax angle to that component.
Well, insurance proceeds get paid out tax-free. And so if you think about it, imagine you have a depreciating asset.
So you get a $400 million check tax-free, right?
Okay. You're getting that tax-free as a claim. And then you basically build out whatever it is, and if something happens to it, you keep it insured. But what they're really talking about in that situation is more or less you buy a depreciating asset, you're writing off the depreciation, and so you're getting some tax advantages along the way. Then something comes in and destroys it, and then the insurance comes in and pays to rebuild it. And you ideally rebuild it less than what they're going to reimburse you for, and then you take the differential and you put that towards other projects, or you build it back better and somehow increase the revenue production that was there. For example, you might have a drill that was capable of X, and now all of a sudden you have a drill that's more capable of fracking, so it's more efficient and you can produce more revenue from it using the insurance proceeds to basically rebuild new technology on the land. And what they were essentially talking about was capitalizing on these older wells and having these older wells fail and then have insurance come in to help finance the build out of new technology that would be better than the oil wells.
Okay.
Old wells.
All right. And is that, so how they were discussing that in the show, is that accurate? Is that something that people really do in practice, you think?
I
Or
think
corporations, maybe.
I think when it comes to buying old assets, that happens more often than we like to think.
Yeah.
I know Texas in particular has a whole thing with old oil caps and whether they're actually capped correctly in the fields, and there's insurance claims going left and right on those. I'm certain the same thing's happening with rigs that are purchased and then need to be rebuilt or something happening. I'm sure.
Was there any concept of like a captive insurance company talked about in the show?
Well, I actually don't remember. Refresh my memory. Did they talk about a captive insurance company?
Well, that's kind of one of the reads I got, is that they had, this influx of capital, and then they formed this insurance entity that they owned and operated, right?
Oh, yes. Okay. So so this has come under high scrutiny by the IRS. So I actually know a few people that have created these captives, not in the oil industry, but in like the auto industry and a few others. You essentially identify an insurable risk, and then you create your own entity to cover the costs of that risk for clients. And they basically feed into a subscription model. They're paying premiums every month, and if something happens, you basically come in and replace it.
Yep.
Now, if you create your own captive, the beauty of that is that it's essentially a tax-exempt entity. You're not paying tax on it.
So you're paying your own premiums.
Yeah, you're essentially paying your own premiums, or other people are subscribing to the service because they're affiliated with you, and they also pay the premiums. The cash in there continues to grow tax-deferred and then pays out on insurance claims. But if you're the one in control of which claims get paid out, as long as you're paying out claims every so often, you can sometimes skirt that IRS scrutiny that comes in and says, should this be taxable or not, as long as you're paying out claims. But if you're insuring yourself, now you have this great big tax-deferred vehicle that's coming in to bail you out every time that something bad happens.
Okay. It does sound like something that is probably getting really close to being a high-risk tax vehicle, if not even something that, is looking under the hood would generate a lot of scrutiny from the IRS. So probably not something that we typically would advise people into from a corporate structuring perspective.
You need a good CPA, especially because the exit strategies with captives
maybe
actually...
a lawyer too, getting a lawyer involved.
You want multiple lawyers.
There was a lawyer on the TV show.
Well, yeah.
Charismatic.
Yes, also, and quite good looking too.
Which one? I was talking about the other guy.
Oh, you're talking about the other guy. Okay. Oh, well, he could be good looking too in another lens.
He was a handsome old gentleman. Okay, so let's change the topic a little bit.
Sure.
So they did talk about the insurance structuring side of things and buying assets and depreciating, but they also talked about like where the investment capital went. And they got into a bit of a pickle with regards to liquidity. So they talked about, we had this additional liquidity influx and we invested it. And then when they talked about where did it go? Well, it went into a bunch of private equity funds and different private investments.
That's your specialty.
Well, it's one of my many specialties. Yes, thank you, Rob. I don't think we're allowed to call it a specialty because it's an endorsement, but it is something that we do a lot of research on. And we spend a lot of time looking at different private investments. Sometimes it's individual companies. Sometimes it's funds of companies. Sometimes it's credit. Sometimes it's equity, kind of all over the place, and a lot of different asset classes. And I think the predicament that, at the end of the day that they got into was they had some illiquid investments matched against a situation where they may need liquidity. And so, when it comes to private market investing, I think, they do bring up a real risk, which is private investments. There is no, publicly accessible market. That's why they're called private. So they're not publicly traded. The liquidity, while I think was a little bit exaggerated on the show, is not always there. There are going to be times where you cannot market a private investment for sale. You just have to own it through thick and thin. And so rule number one for us when we look at private investments is not necessarily understanding all the ins and outs of the asset class or the deal or the legal structure. It's really matching liquidity risk and making sure that before we put our first dollar into private investments or our first client dollar into a private investment where there is a lack of liquidity, that we fully understand that client's liquidity position, that we know that those dollars that we may be potentially locking up for a number of years, but even if not a number of years, potentially locking up for a long period of time, those dollars are not earmarked for any potential near-term liquidity needs. And in this case, near-term could be, as much as 5 years or longer from the initial investment, sometimes 10, sometimes even 12 years, depending on what happens with that investment. It may not be the intention that the investment becomes a 12-year investment, but there are some things that you have to navigate in the private market space that can lengthen the investment horizon.
And just for education's sake, just to back up a bit, because some of the early withdrawal penalties that were expressed on LANDMAN were pretty punitive.
Pretty steep, yep.
But there are different types of liquidity features or thresholds within different alternatives. What are those typically called in terms of the variance in liquidity? Like, I hear semi-liquid, non-liquid. Like, well, what does all that mean?
Yeah, daily liquid, semi-liquid, monthly, quarterly liquid, and then just, drawdown or illiquid.
Lots of hydration.
I could use a little bit of that right now. So there are definitely, and this has kind of really come to market over the past, let's call it five or so years, a number of vehicles that allow investors to invest in and to access private markets that do have kind of quote unquote enhanced liquidity. However, I think what we should clarify is that the enhanced liquidity is really a feature of the wrapper. It doesn't necessarily mean that the asset, the underlying company that's still privately traded, becomes more liquid. You just wrap those investments in a structure that allows some potential liquidity benefits, but typically those liquidity benefits are not 100% guaranteed. So they're kind of more there for if everything's going fine and you want to put a little more money in or take a little more money out, you should be able to do so on a fairly regular and kind of systematic way. Maybe that's monthly, maybe that's quarterly, depending on the vehicle structure, which differs from your traditional private equity investment, which is you place money in or you make a commitment, that money gets drawn down over a number of years, gets invested over another number of years, and that gets returned over another number of years, right?
And by vehicle, you're really saying
fund structure.
Yeah, just the fund that you're buying into is allowing for that little additional flexibility from a liquidity standpoint.
Right. And so I would say one of the more liquid structures are interval funds. You'll hear a lot of talk about interval funds, a lot of marketing going on with interval funds. We tread very lightly when it comes to interval funds at Avidian. We think that interval funds do give you potentially attractive liquidity profiles, but you're also commingling your assets with individuals that may also want to run for the exit at the same time. So we're very careful with the usage of those types of products. But there are things that are in between that are more kind of, they're still evergreen structured funds, but they're more privately traded business development companies or tender funds where there is some periodic liquidity, but it's not guaranteed. If there's a need for the fund to protect the assets and protect the partners of the fund, then they will do so by reducing liquidity. We actually think that's a positive feature of those products. The penalties, though, I think were interesting. And so they were talking about penalties of 60 to 80% loss.
Oh, it was crazy.
They were still in the investment period, so there's no way to get out if you're a defaulting LP. And I think, what I would say, Mr. Sheridan, the guy that writes this program, I mean, he does definitely do some research. And I think a lot of these investments, if you read through their limited partnership agreements, there are liquidity penalties, or sorry, I should say default penalties that are pretty severe. And what he was highlighting, I think, was kind of probably some of the worst, teeth in those penalties. But there's typically provisions that help to navigate a liquidity issue before then. So I think he kind of went right to the worst possible situation, which is, a potential situation, especially in some of these drawdown vehicles. What are the other couple things you mentioned? We talked about PIK, right?
Yes.
We talked about that in the past.
And what does that stand for again?
Payment in kind.
In
kind, yes, in kind with a K, not a C. And so that was an interesting thing they brought up. I guess a number of the loans that I think they were getting involved in had some PIK component, and that was in the show cast negatively because it was cast as, okay, you're just going to build, liability at the back end of your loan, which is truthful. But sometimes that PIK component is a feature of a loan that allows companies to use more cash to grow. It's typically not a good feature when it's used as a bailout, right? I can't afford to pay my interest because something bad happened, so I need to use the PIK feature. That's we would typically say that's a red flag.
So it's just deferring the interest.
It's just pushing the interest back to the back of the loan, and it might compound. Depending on the loan structure, might compound on the principal, or it might be added to the principal. So you have negative compounding working against you. But a lot of times it's more the situation that PIK is used in as to whether it's a flag for a concern around a company, which was definitely the case in LANDMAN, right? There's some significant issues going on with that particular company, but it's not necessarily always, a bad thing to see PIK show up in a loan.
Yeah, it can provide some flexibility, as you just mentioned, especially with high growth companies that might have expanding earnings and are going to turn on profitability at a certain point, basically front loading the capital for themselves on the front end to reinvest in that growth could be the thing that saves the loan and makes it affordable on the back end.
Yeah.
All depends probably on the rate, and they probably do some basic arithmetic to figure out exactly if this is going to work out.
Yeah, no, that's a great point. And just to kind of recap, I think the main thing that you want to take away, right, and we're going to wrap this up in just a minute. The main thing you want to take away is if you are looking at private investments, you do want to understand before you do your first sentence of reading about that particular investment is, can I make an investment and leave that money in that investment for a number of years, right? You don't want to make these investments with dollars that you're going to need tomorrow or the next couple of years, and depending on that investment, if it's credit, it might be 2 or 3 years away. If it's equity, it might be 10 to 15 years in some cases. So understand that first. If you need help understanding what your liquidity picture really looks like, or if you need help understanding okay, there's a lot of different things, a lot of demands on the liquidity, a lot of assets contributing to my liquidity. How do I create a holistic picture? Just come check us out at avidianwealth.com.
Love the plug.